Been an eventful year in markets. Certainly, S&P set for its second straight double-digit gain. The Nasdaq, as we were talking about with Jared Blickery earlier on in the program, up 40% this year. It's also been a wild ride in the fixed income markets. Treasury yields hitting record lows. The Fed emergency cutting rates to zero over about a 10-day period back in February and March. So let's keep our conversation there in fixed income. Jack McIntyre is a global fixed income portfolio manager at Brandywine Global, and he joins us now. So Jack, let's talk about the stimulus that just got through and how that might affect growth and I guess in turn, yields. We've seen the long end of the curve, perk up a little bit. I mean, we're talking about 90 some odd basis points here, but do you see any upside risks, I guess, in terms of yields, again, particularly the long end that can be more sensitive to growth trajectories and maybe what the Fed does in the next couple of years?
Yeah, so expectations are for yields to sort of drift higher. What the catalyst ultimately and always is inflation. So we have to see what inflation is going to do next year. Certainly it's probably going to edge higher just on base effects alone. I don't think it's going to get out of hand. I view this year as sort of this war between the pandemic and the policymakers. The policymakers have certainly been winning. The last round of stimulus shows that, hey, they are probably have won the war. Obviously on the vaccine side of things is more important, but as it ties to fixed income, treasuries don't need to be the flight to safety that they were earlier this year.
Jack, I also want to ask you about fiscal policy for just a sec, because yes, we had that stimulus passed, and a lot of guests have been bringing up with us the special election in Georgia and what that's going to mean for the outcome in the Senate. The trading has behaved, and the conventional wisdom has been that Democrats would not win that election and therefore not take the Senate. But the numbers seem to be shifting a little bit. Do you think markets are going to follow, or do you think it's going to be sort of more down to the wire?
It's probably going to be down to the wire. It seems like everything on the political side is down to the wire these days. We're obviously going to know very quickly in the new year, January 5th. But, as we manage our portfolios, we're making the assumption that the Republicans are going to maintain control of the Senate. Therefore, we're not going to see quite as much fiscal stimulus as we would if the Democrats controlled through all three houses.
Where can investors right now find yield with a reasonable amount of risk? We talked to a lot of investors, and that is one of their biggest challenges headed into 2021.
Yeah, so we're positioned in emerging markets. And we have two reasons for doing that. One is that there is a fairly significant yield premium. It's amazing that we have 18 trillion with a T of negative yielding bonds in our universe. My head kind of explodes when I think about that concept. So there is a huge amount of capital. Capital is going to slosh around into the global markets. It's going to search, I think, for yield, and EM sort of should attract that. And then I think, and I'm in that camp, I think the US dollar should have more downside. I mean, it's obviously not going to be linear, but, we've had a bull trend in the US dollar since 2011. It needs to sort of weaken in here on a sustainable basis for 3 to 5 years. So, we are positioned for EM, and I know sentiment in the short term is certainly probably a little too euphoric, but if you have a longer term time horizon, I still think that's a good place to be.
Jack, it's interesting. We go back to the beginning of the year, and the conversation pre-pandemic was about, this is the death of the 60-40. We're not. And then all of a sudden, we saw this huge rally, in fixed income, and that portfolio actually worked quite well. And certainly that stat about negative yielding debt is concerning. But how difficult are the conversations now with trying to convince folks that there's still a place? We just saw it. There's still a very real place for fixed income within a portfolio. Not even just as a diversifier, but just as a source of, return, capital appreciation on some of those bonds, given the moves we saw.
Which you're right, and it's a conversation I'm having with my clients all the time, because fixed income, what is the role in asset allocation? And you're right, it is. It can be a diversifier. I mean, we're talking about the high quality bonds, treasuries, bonds, Japanese government bonds, et cetera. So yeah, you need a part of that because hey, you don't know what the next sort of big catalyst for uncertainty is going to be. But having said that, though, and it goes back to what I alluded to about that negative yielding bonds, there's a gravitational pull of those very low negative yielding bonds to things that have a yield. And again, it comes down to inflation. And I just don't think inflation in the emerging world is going to get out of hand. If we're right about these currencies strengthening, then inflation in those countries, and I'm speaking very homogeneously in terms of EM, and you shouldn't do that. But I think inflation is going to be well behaved. And that means that you should continue to see yields decline in those particular bond markets.
All right, Jack McIntyre, Global Fixed Income Portfolio Manager at Brandywine Global. Jack, thanks for joining the show. Have a great new year.
Happy New Year.